Two people, the same $60,000, the same starting line, but 20 years later, one has spent years managing properties, the other has barely touched their investments. Most people think they already know who made more money, but they're asking the wrong question. Because the biggest difference isn't just money, it's time, it's stress, it's freedom. Today, we're following two investors who start with the exact same opportunity but choose completely different paths. Emma is 30 years old. Ryan is also 30. They earn similar salaries. They've both saved exactly $60,000. Ryan believes real estate is the fastest way to build wealth. He uses his savings as a 20% down payment on a $300,000 rental property. The remaining balance is covered by a mortgage. Emma takes the opposite approach. She invests her entire $60,000 into a low-cost S&P 500 index fund. Then she sets up an automatic investment of $300 every month. No trading, no stock picking, just consistency. One investor chooses leverage, the other chooses compounding. Both are convinced they made the right decision. 1 year later, Ryan feels like he's winning. He owns a real property. He has tenants. Rent checks begin arriving every month. Friends congratulate him. He finally feels like a real investor. Emma's experience couldn't be more different. She owns nothing she can touch. No building, no tenants, no monthly rent checks. Just a number on a screen that barely seems to move. If investing were judged by excitement, Ryan would win without question. But investing isn't judged after 1 year. And sometimes, the quietest investment tells the biggest story. 5 years later, the difference between their investments becomes clearer. Ryan's rental property has created income, but now he discovers something many new investors overlook. Revenue is not the same as profit. The rent coming in every month looks impressive, but behind that income are hidden costs: property taxes, insurance, maintenance, repairs, and months when the property sits empty. One day, Ryan gets a call from his tenant. A major pipe has broken. The repair bill costs over $2,000. The property still has value, but suddenly, his passive income requires his time and attention. Meanwhile, Emma's investment journey looks completely different. Her portfolio has experienced good years, and it has experienced bad years. Some months, the market rises. Other months, headlines create fear. People tell her to sell. They say the market is crashing, but Emma follows her plan. Every month, she continues investing. She doesn't try to predict the perfect time. She doesn't react to every market movement. She understands that building wealth is not about avoiding every decline. It's about staying invested long enough for growth to happen. At this point, both investors are learning an important lesson. Every strategy has a cost. Ryan's investment gives him control over a physical asset, but it requires more involvement. Emma's investment gives her simplicity, but it requires patience and emotional discipline. One investor manages a property, the other manages her own behavior. And sometimes, the hardest investment decision isn't choosing where to put your money. It's choosing whether you can stay committed when things become uncomfortable. 10 years later, the gap between their strategies becomes even more interesting. Ryan's property has increased in value. The $300,000 home he bought years ago is now worth significantly more. His tenants have been helping pay down his mortgage. Every payment increases his ownership. This is the power of leverage. Ryan didn't need to save $300,000 before becoming a property owner. His $60,000 gave him control over a much larger asset. When the property grows in value, his original investment benefits from that growth. But leverage comes with a warning. It can multiply success, but it can also multiply mistakes. If the market drops, if repairs become too expensive, or if the property stays empty for too long, the same leverage that helped him can create pressure. Meanwhile, Emma's investment has entered a different stage. At the beginning, most of her growth came from the money she personally contributed. But after years of investing, something changes. Compounding begins to take control. Her investments are now producing returns. Those returns create more returns, and those new gains continue building on themselves. The process feels slow at first, almost invisible, but time changes everything. A snowball doesn't become powerful because of one push. It becomes powerful because it keeps rolling. Ryan uses borrowed money to accelerate growth. Emma uses time to accelerate growth. One strategy depends on leverage. The other depends on patience. And this is where many investors make mistakes. They look for the strategy with the highest possible return, but they ignore the strategy they can actually follow. Because the best investment strategy isn't only about numbers. It's also about your lifestyle, your personality, and your ability to stay consistent. And after 20 years, their final results reveal something most people don't expect. 20 years later, Emma and Ryan meet again. They started with the same amount of money. They had the same amount of time, but they built wealth in completely different ways. Ryan looks at his rental property. The mortgage is almost completely paid off. The property is worth much more than when he bought it. His tenants have helped him build equity over 2 decades. He created a valuable asset that can continue producing income. But his journey wasn't completely passive. He spent years dealing with maintenance issues, finding tenants, making decisions, managing problems. His investment created wealth, but it also demanded his time. Now Emma looks at her investment account. For years, it seemed boring. There were no buildings, no tenants, no physical asset to show people. But behind the scenes, compound growth was quietly working. Every contribution, every reinvested return, every year she stayed invested. All of it added up. Her portfolio became a powerful wealth-building machine. Who won? The answer depends on what you measure. If you measure control, Ryan has the advantage. He owns a physical asset and can influence how it performs. If you measure simplicity and flexibility, Emma has the advantage. Her investments require very little daily attention. Ryan built wealth through leverage. Emma built wealth through consistency. Ryan accepted more responsibility for the possibility of higher returns. Emma accepted market uncertainty in exchange for a more hands-off approach. Neither path was easy. Neither path was guaranteed. Because every investment strategy comes with a trade-off. Real estate can create wealth through borrowed money and ownership. Stocks can create wealth through diversification and time. The mistake is believing there is only one correct way to build wealth. The real question isn't, which investment is better? The real question is, which strategy fits to the life you want to build? The biggest mistake investors make is not choosing the wrong investment. It's constantly changing strategies before they have enough time to work. Some people buy stocks, then panic and sell when the market falls. Others buy real estate, then quit when they realize owning property requires more work than expected. Building wealth is not about finding a perfect strategy, because a perfect strategy does not exist. Every choice has advantages, and every choice has sacrifices. Real estate rewards people who understand leverage, ownership, and active management. Stocks reward people who understand patience, discipline, and the power of compounding. The best investment is the one you can stay committed to for decades. Because wealth is rarely created from one lucky decision. It is created from thousands of small decisions repeated over time. Saving consistently, investing regularly, avoiding emotional mistakes, and understanding how your money actually works. Whether you choose real estate or whether you choose the stock market, the most important factor is not the investment itself. It's the investor behind it. Because the market does not reward the person who looks the smartest. It rewards the person who stays disciplined the longest. This is Pocket Wisdom, where we break down money, investing, and wealth-building concepts using logic instead of hype. If you want to understand how money actually works, subscribe for more financial lessons designed to help you make smarter decisions with your future. Because the more you understand money, the better decisions you can make with it.